Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagerin. Hey, Doug.
Hey, Kirk. How you doing? It's been a heck of a week.
It has been a heck of a week. We're starting early today because we had some conflicts, and it's been an interesting week all around. I won't spend too much time talking about politics because we don't do that in the show, but I can't give a moment of silence for Charlie Kirk, who has a good influence on the world, whether you agreed with him or not. Sad when Looney Tunes take out good people. So I won't give him a moment of silence, but I think everyone, even whether you agreed with him or not, he was a good influence on the youth and got people to think. So anyway. But I will say I would like to thank all my Democrat friends who have now migrated away from the Democratic Party, which is now is the party of hate and the party of violence. So thank you all for basically leaving like rats from a ship from the Democratic Party. I don't know where your new home will be, but it certainly won't be the party of hate and the party of violence. So thank you all for that shift. If you haven't made the shift yet, I highly recommend it because you don't want to be associated with what's going on. All right. Now, enough about that. I'm a little perturbed, but I'm trying to keep this above board. So let's dive right in. We talked a lot about last week. Talked a lot about the shift going on in gold and silver and mining stocks, and it's a crazy shift. We've had a lot of change start to happen. And I'm going to start to pull up. Let me see if I can pull up one of these charts here because I think it will be relevant. Let's see, I closed it. All right. So let me see if I can pull it up here. So one of the things I would like to, let's see, I got to share this again. This is always fun. I'm trying to deal with computers. There we go. All right. So I want to share again what's going on because I've got a lot of feedback from the audience after last week's show. I think a lot of people were unaware of what's going on in gold, and I would just like to point out this is the 2-year chart. Gold has gone from about 2,000 up to 3,600. If you look in the weeklies, this goes back to 2017, where gold was about 1,100. Now it's 3,600. Woohoo! That's all I got to say. Gold has done phenomenally well, and I want to start here and build out the thesis again because I want everybody to understand. All right, so this is the chart for gold. If you go back even further, gold was in a bear market up till about 2001, where it was about $250 an ounce. Then it went on a rip-roaring bull market up to I thought it was 1,800, but this chart shows it going a little higher. Anyway, it was about 1,800 at the peak, and that was 2011. And then it went down, and I wouldn't say it was a bear market, but it definitely was soft for a lot of years, pretty much from 2013 to about 2019. So you're looking at about a 6-year. I wouldn't call it a bear market. I'd call it a sideways market. Bear markets are when it goes down, but it's really just kind of went sideways. And then from 2018 until today, it has just gone on a rip-roaring market. And I want to point a few things out. One is we've been printing a buttload of money. I think that's a technical term. Buttload of money that we printed. And surprisingly, things did not, I'll point this out for all you gold bugs. But things started to take off. And then right after COVID, things pretty much flatlined for a few years. Now, I want to point out a few things. One, we printed a buttload of money during COVID, and it did not influence the price of gold. You might think, well, what happened? Well, we never know. So I'm just going to call it out what it is. You never know. You can claim this, that, and the other thing, government manipulation. Maybe it is. I don't know. All I'm going to tell you is that during COVID, you could not find coins to buy, and yet the price of gold dropped for whatever it was this month right here. So February, you literally could not get gold during COVID when everyone was stuck in their house, and yet the price dropped during that period. It was a little bit crazy. Here it is. This big March, there was a big spike up and down. So things aren't always rational. They don't always make sense. We try to make sense of the world. We as human beings like to look at the world and make sense of things. And we do that by coming up with explanations when there aren't any, right? What was I forget, there was a quote by, I forget it was a scientist or a sci-fi writer. It was like, basically, science that we don't understand, we deem as magic, right? We just don't understand it, so we think it's magic. It's the same thing. We as human beings like to come up with explanations for things if we don't have one. Why does the sun cross the sky? Well, it's a god that's pulling a chariot that's pulling the sun. Over time, and human beings have come up with all sorts of crazy explanations because we can't have a non-answer. There has to be an answer to it. There's a void and it needs to be filled, so we fill it with something. That happens in a lot part of our lives, and we try to make stuff up because we don't like a non-answer. It's scary. So why did gold go sideways from 2020 until 2023? Don't know, and we'll probably never know. They printed a lot of money, and yet it went sideways. Okay, that's fine. But here's what you need to know. It's going up now. I know, I'm being very technical today. It's going up now. So starting in 2024, around April, whereas about 2000 and let's call it 2100, it's taken off. Now it's at 3600. If you look at this chart, it has absolutely skyrocketed since 2023. It has just gone, I don't want to say straight up, but for a commodity like gold, it has done very, very well. Now you might say, well, what's going on? I don't know. But here's what I do know. Central banks are buying gold. Now, they've been buying it right along. They have been for many, many years, especially when we deem, oh, it's okay to steal Russia's money and their reserves, and we're gonna basically steal all their stuff. Why wouldn't they buy gold? You know what? Why wouldn't every country around the world start buying gold? Because they don't trust us anymore. Nor should they. Why would we do that? That was a dumb move. It never should have happened. We won't get into the politics of it, but that never should have happened. It was really dumb on our part. And I blame the administration because they were run by monkeys. But basically, other countries are saying, well, we don't trust the government because if we go against them, they're just going to steal our stuff. So we're just going to buy gold because gold has value. Now, if you look at this, you can see clearly central banks are buying. Not necessarily retail. And here's the interesting part. Okay, so if you look at this chart, and I can't do an overlay because I don't have a paid version of this, but I'm just going to try to share. All right, so if you're looking at about 2024 in March, you look at silver. Silver's also gone sideways. It's kind of gone a lot of sideways. It really, if you wonder what goes on with silver, here's what goes on with silver. Silver is a retail commodity. What I mean by that is there is a lot of industrial use, and the industrial use is stable. It's something you can predict. The silver coming out of the ground is stable, something you can predict. So it doesn't really change the price of silver. Now, if an asteroid mile wide of silver hit the Earth, okay, well, maybe that'll change the supply and demand. But generally speaking, supply and demand is pretty stable. So what is going to move the price of silver? Well, not central banks, because it's too small. I'm going to buy an ounce of gold. It costs me $3,600, almost $3,700. Buy an ounce of silver. What's it today? $42, $43. That's going to be a lot of silver you got to put somewhere. It's going to take a lot of space, a lot of money to store it. Central banks are not going to be buying silver. Who's buying silver? Retail, the retail public, you and me. That's who's buying silver. Okay? So when you see this flat line, it means nobody's interested in silver. Now, I know the argument. Some of you gold bugs, whoa, hold on. The central banks are manipulating the price of silver, and the guys in the conspiracy in the dark room with the smoky dark room that are manipulating the world, they're keeping silver down. Really? I've heard that argument before. Why? Why would they do that? It doesn't make any sense. They don't care about the price of silver. Now, were there times in history where it was being manipulated? Absolutely. Now is not one of those times. People don't give two craps about silver. in the bigger picture. Why would they ignore silver and let gold take off for multiple years? If they were trying to manipulate the price of metals, why would they let gold take off? They wouldn't. They don't care about silver. So the reality is silver has different dynamics than you think. I know you've heard all the newsletter writers talk about, oh, they're gonna manipulate the price of silver. Just price is all that matters. Okay, they have no reason to manipulate the price of silver. Gold, yes, because gold has a lot more implications globally with central banks and banking. Silver does not have that. So there isn't the institutional interest in silver. If you want to know my theory, there is no institutional interest. The only institutional interest in silver is from you and me, from an ETF, like SLV is the biggest one, by an ETF. And if retail public is buying silver, it's going to start to go like this: 2024 to 2000 and until today. It's going to go from $23 up to $42. That's going to happen when you and me start buying silver, which we are. As you can see, we have started to buy silver. Everyone has, because the price of silver is going up. So gold starts, right? As you can see, gold has taken off. It's taken a little vacation here, but it's definitely started to take off around the same time. Central banks have been buying this all the time, but now they're starting to pick it up. Silver also starting to pick up right now. So the retail public is on board. They've figured it out. Okay, time to buy gold. Time to buy silver. As you can see here, platinum hasn't done the same thing. Platinum's gone nowhere for like the last, whatever it is, 10 years. Platinum historically has followed silver and gold, but no one seems to have any interest. And this aside, I'm going to keep that aside for a moment. I'm not going to talk about palladium. Copper's kind of weird. Copper had that big drop. So, but anyway, my point being is this. Okay, you had silver, you have gold, and now you have the mining stocks. Here's GDX, which is a mining stock ETF. And it's kind of following the same patterns, right? Around March 2024, it's $26. Now it's almost $70. Okay. Now, if you've looked at it over the last 20 years, it's kind of done a whole lot of nothing. Yeah, it's gone up and down, but it's really done a whole lot of nothing. Why? Because mining stocks are the worst businesses in the world. You take $1 billion, you buy a piece of land, and there's some value there, hopefully. Let's say you find it, and then you pull it out of the ground and sell it. Now the land is worth less. It is an appreciating asset. It is a terrible business model. But we need it. And so, they make money at it and all that. But my point is, it's a terrible business model. So why would you ever invest in mining stocks? Well, when they look like this. So if you see this year, mining stocks have gone up a lot. They started right around 34. Now they're at 70. We're looking at a double. Mining stocks have absolutely killed it this year. Why? Because the retail public is buying it. Central banks aren't buying this. Institutions want nothing to do with material stocks. If you look at their portfolios, they rarely, if ever, have material stocks in it, or they're a very low allocation. No one wants to buy mining stocks or stocks associated with mining because they're terrible businesses. Why not buy the Mag 7 that grows at 100% a year in their stock price? So that's what everybody does. So anyway, so the point being is, if you look back here, obviously it's grown same time period. If you're looking at March 24, that's kind of the low point, but it's gone up a lot, especially recently. Now, here's the junior miners, which are basically, as I said last week, they're the mining stocks, but worse because they're basically a lit match. They're completely worthless. They always are, but people speculate on them, and then they go to great heights. I mean, this might go back to all-time highs. But if you notice, gold has taken off, and these things for 2011 was the peak, right around 174. Right now it's at 90. So these are terrible, terrible businesses. But as you can see, when they go. In the last few months, it's gone from like 50 up to 90. And it's just getting started. As you can see, it's got a long way to go to hit the old highs. So my point is this. When trends get started, you have to understand what drives them. The first thing that drives trends is In this case, in precious metals, is gold. Gold goes first. Central banks, institutions buy gold. Uber wealthy people buy gold. As you can see, it's done very well in the last 2 years. Silver's next. Silver also starts to take off, which in the last few months has definitely started to skyrocket. You can see institutions are getting, you see retail public is getting in. And then lastly, you go with mining stocks and very last, junior miners. And junior miners are basically a call option on, if you think, so gold is the precious metal, silver is like gold on steroids. Mining stocks are like silver on steroids, and junior miners are like mining stocks on steroids or crypto on steroids. Junior mining stocks are crazy. It's kind of like buying crypto. So I'm not saying you should do it. I'm just explaining the trend and how things work. I follow this a lot. I can tell you this is how it works, and I can tell you that we are just getting started. I do expect there to be some sort of a hiccup because things have gone up a lot in the last few months with not much reprieve. So I do expect a bit of a hiccup in the price. However, you should look at that as a buying opportunity. If silver, I mean, if you look at historically at silver, you're going back, the peak, the recent peak was 50. Okay. If you're going back 2011, the peak was 50. We're at 42. We've still got ways to go just to hit that. Probably you're going to see some resistance at 50, be my guess, because that's what happens when you hit a peak. When it retests it typically doesn't bust through. It could, but it typically doesn't. However, silver is just starting to take off, so you should take full advantage of this while it's doing that, and make sure you manage your risk properly. But I want to point these things out because I think it's really important that people realize what's going on and how to operate it. Because if you just start throwing money into silver junior miners because Tom, the social media bot, says buy junior miners because I'm pumping and dumping, don't do that. Just focus. If you're an expert in it, you can pick stocks. If not, just go with like an ETF. Don't bother picking the individual stocks. I can tell you I've done that in the past. You can do very well, but it's a lot of work, and I can tell you most of you are not equipped to analyze mining stocks. They're very difficult. There's one or two people that in the world that I know of that do it well. Most people fumble the ball, even pros. So just to be clear, insurance is another industry that pros don't understand. Maybe one or two people do, but everyone else has no clue. So it's easy to analyze tech stocks, value stocks, but when it comes to these things, just be careful. Don't listen to Joe newsletter writer just because it sounds good and he writes a good article. Don't listen to that. It sounds good. Maybe you make money, maybe you don't, but that's what we call gambling. So if you don't know what you're doing, just focus on the ETF. You can get the meat of the ride, and that's really all you need. You're there to make money, not to feel good about yourself. So that's what I would suggest. I'm gonna hand it back to Doug, but I did want to go through that again because I've gotten a lot of questions on this, and I really want to address it. And like I said, we're huge fans of gold and silver right now. They are on a roll, and I don't think that's going to stop considering lower interest rates, money printing, all the stuff that's in our future. I just think we're heading for a lot more inflation, and I don't think we can stop this train. Doge did, to my knowledge, did not do much of anything. So I think we have inflation into infinity at this point. So find hard assets, have some in your portfolio. I think you'll thank me later. Hard assets are a way to protect against inflation, even if the market crashes. You always have the hard asset. So that's my 2 cents. Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money.
Yeah, I think it's telling when you are seeing so much of the reserve currencies of nations stocking up on hard assets like this. The what's driving this, just to kind of go a little bit deeper. I mean, obviously we record gold prices, huge with rate expectations. There is a right now, I mean, there's a massive expectation, and we've seen this time and time again, that they're going to cut rates. They are looking to appoint another director to the reserve. I think that the odds seem to be pretty high that Trump's appointee is going to get accepted and then be there in time to vote. There's questions on whether or not I forget her name, that Trump's trying to remove. If she, now that the courts have stayed that, she'll probably be there still trying to vote, although he's appealed. Lots of back and forth between, the executive branch and the Fed between what, their, pseudo independent mandate is, and of course what the executive branch is hoping that they'll do. Right now, expectations are back up wildly that they're going to cut rates. Now, we've seen this before, and they've come out and they've held firm. We've got more inflation data coming in that would indicate to say that they shouldn't, but that doesn't mean that they're going to follow and not buckle to this pressure. We've got, and so if we're looking at lower real rates and rising inflation, I mean, then there's that argument of gold and precious metals being a safer store of value. If we look at silver, I mean, it faces a dual role. It also faces supply constraints. It is showing strength finally, and it's rare that it does carry both industrial demand, like you see it in solar panels, electronics, green energy. You see it in antimicrobial usage. But it's also monetary hedge appeal. But the supply on silver is very constrained. Much of the silver comes as a byproduct, not directly mining it, like they go after gold, but actually as a byproduct of other mining, such as going after copper, zinc, etc. And that new supply doesn't respond quickly to price. And right now, if we do see a slowdown in the economy and some headwinds in the economy, especially in builders and housing and stuff, they may not go after copper as much. They may not go after mining zinc as much. And that may then create constraints on mining more silver as a byproduct. There's structural demand. Central banks are boosting gold reserves. Silver, as we mentioned, is recognized as a critical mineral. Global economics, are leaning towards de-dollarization in some places. So, again, retail seems to be interested. From an investment demand through ETFs and physical bullion is rising. And go back to something we've talked about, the gold to silver ratio, that does suggest opportunity. We're still seeing, even though with that spike, silver's cheap relative to gold historically. And if and when that ratio reverts towards long run average, silver does often outperform gold in relative terms. What does this mean in terms of investing, big picture? Passive isn't enough anymore. Okay, so the last 15, 20 years, there's just been nothing but talk about buy passive, buy index, buy fixed. Many portfolios lean heavily on this, on the passive broad market or fixed income indexes. That's worked when correlations were stable. Bonds did their job as a hedge. But now that we're seeing rising correlations across stocks and bonds in inflationary geopolitical stress regimes, precious metals don't always move with them. So these passive strategies will often underweight or ignore hard assets like metals until everyone else is in, which that can mean buying close to the top or missing out on early gains. So, this is an opportunity, and with majority of Americans invested predominantly in 401ks and really lacking the accessibility in those 401ks at least traditionally, this is it's an opportunity and a risk at the same time for the average investor. Now, there are many retirement plans out there that have opportunities to invest outside the plan through self-directed brokerage. This could be an opportunity to take advantage of that. It could also be an opportunity to revisit whether or not investing outside of your 401k in Roth IRA investing, if your income allows it, or doing IRA investing and then converting, or just, a traditional, taxable brokerage might be a good time to start thinking about that in terms of a diversification, and then adding these precious metals as a hedge. Mixing in physical gold if you can find it, on precious metals. Costco now and then has bars they sell out like this. ETFs, and as Kirk was saying, miners for leverage upside, but remember that you're going to get added risk. And also consider critical metals policy impact. I mean, government declassification, supply chain policies can swing demand very, very quickly and change supply curves. So these aren't just the old safe havens. They're looking like mission critical insurance in a world where inflation refuses to go away. Currencies are under extreme pressure. Passive allocations are getting squeezed in almost all directions. And so if you're serious about preserving wealth, protecting income, and being the outlier who doesn't just survive, but also thrives, you're going to need to think differently around metal and commodities, but really in this case, precious metal allocations could be one of the most underpriced moves that you can make. Last thing I'm going to say on this is just, again, about the inflation. It's not dead. I got an itch I can't get rid of. Sorry. It's mutating. The headline inflation, it's cooled, but core inflation is still sticky, and we've seen an uptick. And service costs like healthcare, housing, insurance rising well above long-term averages. We can say, pros and cons on the tariffs, but again, just think about this. I'm drinking a cup of coffee right now. Coffee prices are up 20% just in the last week. So that's making it very, very, we are starting to see that, some areas of where just being able to get it out into the country. So for example, coffee, a lot of it comes from Brazil. There's a 50% tariff from Brazil. Guess what? You're going to start seeing that directly or indirectly in the cost. And so that could add to what we call classic slow burn inflation, chipping away at savings, fixed income returns, and without shock headlines. Stagflation. That's what we call it. Now, right now, the markets are still moving, so we don't have the stag. We've got the flation. But if we look at what stagflation was in the 70s, and if we get into a recessionary scenario, stagflation was basically from the 1960s to the low 80s. The S&P 500, which everybody thinks just keeps going up. Now, you and I have talked about 2000 to 2013 on a number of times. It was down for 13 years. But between the late 1960s and the early 80s, it only grew by about 0.8% a year. So it's not like this, these American stocks just continue to explode. There is extreme secular cycles where the just passive sitting back and letting things rise no longer works. Those scenarios are periods when hard assets outperform because the store of value perception in them happens when currencies weaken. These precious metals now then can become an inflation hedge, to help grow purchasing power and fiat money is debased. In the last 5 years, you have to understand the dollar's lost roughly 50% of its value against gold. When we talk about, we've talked a little bit about how the dollar goes through these very long cycles. And think of it like solar cycles, and if we are in a long-term cycle, there's going to be a change in how we have to perceive how we allocate against what now could be a longer-term declining of the dollar, whether or not that's being forced or whether or not that's just part of its normal cycle. This is a signal that in real terms, cash has already been devalued, again, even without any hyperinflation headlines. And now you're seeing it. Central banks are buying gold aggressively to diversify away from those reserves. And now silver can add a second driver. Industrial demand, which, from solar, electronics, green energy, yes, there's been a pullback. Yes, we've taken away some incentives, but it's still, it's still there. Again, your 60-40 stock portfolio, they typically rely on bonds to hedge stocks. But in the last few inflationary years, we've seen those stock bond correlations turn positive. They fell together. Passive index allocations that worked for decades aren't offering the same protection. And then inflation on top of that erodes bond real returns. Equity valuations then eventually suffer when rates stay higher for longer, which is why we're seeing all of this optimism, and let's just call it hope, that the rates get cut, because otherwise there is a higher chance that these equity valuations and the impact of these higher bonds could sneak in. And that means that simply set it and forget it. Target date funds, just passive indexes, no longer may have the long-term effect benefit that they've had for a while. So I'll turn it back to you, but I just want to say, bottom line, inflation's quiet persistence is a slow tax on wealth. Gold and silver are rallying because investors, central banks included, see the dollar's purchasing power slipping. And in today's world, sticking only to passive allocations may not be enough. An intentional, active managed metals allocation, as well as other alternative type of allocations, could really begin to help protect against real income and preserve long-term purchasing power when these traditional stock bond playbooks break down. And right now, in what Kirk was saying, is you are really at the forefront of that opportunity. Eventually, though, they will gain in value and that opportunity will diminish.
Yeah, no, I think that's great, Doug. And by the way, Doug just reminded me the quote, Arthur C. Clarke, "Magic's just science that we don't understand yet." That is the quote. Thank you for that, Doug. So I want to point out, let's see if I can share this. All right. So I want to point out a few things. So I was just sharing the dollar chart when Doug was talking. I also want to share this, and this is these are the futures for bond yields. Now I'm sharing this because I want you all to see. Right now, Trump has been chin-wagging to Powell to lower rates. And
pork bellies. Oh no,
yeah,
I'm looking at the wrong chart.
Yeah, wrong chart. It's funny because right before the election, Powell dropped interest rates 50 basis points when I talked about in the show they shouldn't have dropped it at all. We were fine where we were. And they did it, in my opinion, for political purposes. And there wasn't as much of an uproar as I would have thought, maybe because everyone was happy that rates are lowered and stock prices are going up. But I can tell you the economy is not as sound as you might think prior to that. And I still don't think it's all that sound. Even though Trump's doing some things, I don't think it's changing much yet. Now, I would like to point this out because I do say it every once in a while, and I don't want to be hypocritical. But if you look at this, presidents have almost no influence on markets. When I say almost no, they generally don't. There are some policies that do have an impact on markets. Generally, they don't have much of an influence. So people give Bill Clinton all the credit. They give W all the blame. They do all these sort of things. They give Obama credit. Oh, look, Obama got elected and the markets went up. Yeah, I'm pretty sure it wasn't Obama that did that. But that's okay. I get it. That's what people do. But the reality is they almost have no influence. Now, they do occasionally have influence, right? So Trump is basically, calling Powell names and getting him to step down. That's influence, and that is a rare influence that a president would have. Most presidents would not say anything to the Fed. They would just let them alone, let them do their thing. Trump doesn't do that. And in 2020, it worked in our favor because he kept yelling at Powell, hey, drop rates. And he didn't do it until he finally made him look stupid. And then he did, which the timing was fine. I think what probably would have happened if he didn't say something is it would have dragged out for another 6 months. The whole world would have been a lot of pain, but Trump made him look silly, and so he just did it. That was the right move on Trump's part. We should have lowered rates. It kept the world from falling off the cliff, even though the whole world was shut down. It's still weird in my book. But anyway, that was the right move on Trump's part. Now he's yelling at him to drop rates. I don't think it's the right move. I think that is, I get why he's doing it, right? He wants a better economy. He wants to put a boost in the economy. But at the same time, all we're doing is we're just causing more inflation. We're not solving any problems. So I don't think it's the right move. I understand why. It's fine. We will all benefit in some way if you own stocks. So I want to be clear. I'm personally for it because it helps my portfolio. I'm against it from a macro perspective because I think it's going to hurt the economy overall. I think you're just creating more problems. You're sticking more stuff under the rug, and eventually it's going to be a problem. So, I want to play both sides and be honest, but that's how I see it. Yes, we all want the markets to go up, and this will cause the markets to go up. It should, but it's not good long term. We're just creating more problems or speeding them up, I should say. I think rates should be where they are, and they should just stay there for a long time because it doesn't seem to be impacting the economy at all. Now, I will also point this out that when changes happen, it can take 6 to 12 months before you see an impact. So Trump's tariffs, that was April. It's like almost 6 months. We're not even 6 months yet. So you generally don't see impact for 6 to 12 months. When you saw the inverted yield curve, right, and then it starts to revert back to normal, that's I think the earliest was 9 months to 24 months before you saw a recession, which has a really good track record of predicting recessions. The yield curve has reverted, so I forget the date, but it's still far in the future. So I think we can expect a recession if that leads to one. I actually am suspect on that because I think that the reason that it used to cause a recession has changed. It used to be that banks weren't making any money in an inverted yield curve, so they're losing money, and they're losing money they're not going to lend, so that slows the economy, causing recession. But now the banks don't cause recessions or booms because they're not really lending, and people are getting a source of funds elsewhere. So I don't think we have the same underpinning kind of machinery that we used to have. Now, I do want to point something out, and this is why I brought up this chart. So we got a 30-year, the 10-year, the 5-year, oh, crap, and the 2-year. Well, as you can see, the 30-year is kind of flat. Now, Trump's been talking about how he's going to lower rates. Well, if he lowers rates, the price of bonds should go up. It's an inverse relationship. Yields go down, prices go up. Yields go up, prices go down. So Trump's talking about lowering yields or having Powell lower yields, which I think everybody agrees is going to happen next week. I think it's like a 96% chance they're going to lower rates, 25 basis points, and like a 30%, 20 or 30% chance he'll lower. I think it's 20% chance that he'll lower it 50. I don't think he'll do 50, but anyway. So as you can see, the 30-year isn't going anywhere. The 10 years moving a little bit, not much. The 5-year, the 2-year, yeah, those are moving, right? They're starting to move. Definitely the 2-year. So the thing to keep in mind is normally these all kind of follow the same game plan, but right now we're not. Now, what this means, and this is why I bring this up, is the 2-year should relatively reflect what the Fed's doing because it's closer. The Fed is basically it's the Fed funds rate, so consider it like a 0-year note, and then you've got short term, you got 2-year, 5-year, 10-year, 30-year. So the closer you are to the 0, the more likely you are to follow what the Fed funds rate does. The further away, the less likely. It typically does. Like it typically follows the path, but not right now because in large part institutions aren't buying it. They're saying, "Yeah, I'm not buying it. I still think we're going to have inflation," and the bond market is usually correct. So if the 30-year and the 10-year think that we're going to have inflation and rates are going to go up, right now they're sideways, but they're the 10-years edging down a little bit in yield, but basically they're kind of flat. So it's just something to keep in mind. It is going to have an influence on the markets, and so you should be aware of it. And so just keep watch of that. If you start to see them take different paths, that's when you would start to be concerned. Because what that means is the Fed is wrong, and there's something. It's one of those moments we talk about in the show. Isn't that interesting? That would be a moment I would say, interesting. They're separating. That's not a good thing. That means one of them is wrong, which inevitably is the short end of the curve, because the short end is what tries to manipulate everything else. The long end is what the market sees. So if yields start to go up in the long end, be worried. Be very worried. Right now, it's not, but that is something you should be aware of. So I did want to point out one more thing, and I'm going to give it to Doug to wrap it up. So I had shared this earlier about gold and silver. So I don't know if you noticed, but in the last year, people are selling mining stocks. They've been selling up until August. They're just selling everything. I mean, huge sales of mining stocks. Even though gold's going up, silver's going up, mining stocks are going up. They've had a great year this year. No one seems to care. They're just selling them hand over fist. That's weird. Apparently they got the memo because they're buying them now. But that's weird. Here's another one. This is fund flows into gold. As you can see in the last month or recently, it spiked, but actually it was kind of quiet prior to that, which is also interesting. It should have, with gold going higher, you'd think it would have done better. Here's another fund flow chart just to kind of show more recently. So here's the stock price overlaid on the fund flow. So you can see people are like selling this stuff, and the price just keeps going higher, and people are selling. Like, okay, good luck to you. I wouldn't have done that, but I shouldn't say that because I didn't. I didn't own it prior to that. I don't think so anyway, but not my personal portfolio. Not in. Anyway, I won't get into what we own, but I'm pretty sure we didn't own it. So anyway, point being is this is something you should be aware of, is the dynamics in play. So what do you think is going to drive the mining stocks higher? Fund flows. So they've obviously been going up because they're worth more, but now that the retail public is getting in, that's going to also drive prices higher. So there should be a huge wave of people once they notice that GDX is up like 100% this year. They're going to see, oh, why am I not in that? That sounds like another NVIDIA, like 100% year. It's not too late, but I think the party's just getting started because the retail public is typically late to the party. And I don't even hear people talking about it. Like Doug and I have been talking about it for months. People are just starting to talk about it. I think the last 2 weeks are the first time I heard anything about this on any podcast. No one's talking about this. So we are very early to the party, which is a good place to be because if you're looking to make money, you want to be early to a trend, not late. And you're definitely early to this trend. It's got a long way to go. I remember the last 2011 trend. Every Tom, Dick, and Harry is like, how much gold do I have? How much silver do I have? What junior mining stock? I mean, I had people telling me junior mining stocks and how great they were. I'm like, why are you telling me? Like, okay. It just like, I get it. I'm managing this stuff, but I got it. These ideas, there's plenty of ideas, but who cares, right? You want to feel like you own something, like this is my home team. I picked this, but at the end of the day, all you want to do is make money. It doesn't matter what you own. It's about making money. So at this point, I think for most people, the ETFs are a good substitute for mining stocks. I typically, I use ETFs for sectors that are hard to manage, like high yield bonds, for instance, really, really hard to manage. So ETFs are probably good for that. Mining stocks, the same. I think for most people, it's a good idea. I've got some great lists of mining stocks, but is it worth it? At the end of the day, probably not. You're not going to get much alpha from the individual stocks compared to GDX. Probably because one of the biggest mining stocks in the GDX is actually in good shape. I'm not going to name it, but it's actually turned its ship around. It used to be in a horrible shape. Now it's actually in good shape financially. So I think that's a big part of this. And as long as that is going to push it higher, I think you're going to start to see higher numbers. So anyway, Doug, take us home here.
Thanks, Kirk. So if you haven't heard the theme and that we keep repeating over and over and over, and that is inflation isn't just an economic headline. It's a silent tax. It erodes your wealth year after year. And you're going to see it everywhere. The dollar, as I mentioned, has lost half of its value against gold in 5 years. And college tuition, that keeps rising at twice the pace of general inflation. I know Trump's trying to affect that, throwing out some things like the one big beautiful bill and reducing loans, which is only going to create more pain for families in the short run as this starts to adjust, hopefully over the long term. For high-income families, that hit's going to be even worse. Every tuition dollar comes from after-tax income. So a $400,000 private education can require earning $650,000 or more just to write those checks. And it's not just a college bill, it's a direct assault on your future income and your retirement security. And so this is how your wealth gets quietly drained. You think you're in control, but without a coordinated income plan, inflation and college costs they're going to rob you from the very thing that matters, the ability to afford what you care about most, your lifestyle, your retirement, and your legacy. And here's the trap. Most affluent families think, why plan? I make plenty. I have too much for this to even matter. But that false comfort is exactly how fortunes erode. The more you earn, the higher your tax bite, and the faster unchecked costs can chip away at the income you'll need later. And as we've discussed, the financial industry isn't helping. There's too many advisors that avoid the complexity of college planning. They default to half truths. They just say, just open a 529 and move on. And that lazy advice, that may feel safe, but it can cost millions over time. And the truth, it's not about the pile you've built. It's about the income you can reliably draw without running out. This is why even families with $3, $5, even $10 million, they're coming out and saying, we still worry. This inflation is going to be a massive problem. They have the accumulation, but they don't know how that's going to apply in an income plan to what their lifestyle demands going forward. And college is one of those biggest drains. Tuition today can quietly rob retirement income tomorrow. So here's where smart money separates itself. As we've said in the theme today, being early to a trend. That's how wealth endures. Planning how you'll pay for college before the bills hit. That's not just smart. It's being early to the trend of disciplined, forward-thinking wealth management. The families who act before the crowd are the ones who keep their capital working and their lifestyle is intact. So here's the gut check I want to leave you with. If you've had any doubts about the advice you're getting on college funding, retirement income, or protecting your wealth, listen to that little voice. Millionaires who fear running out of money, they're not paranoid. They're the ones who know how fast things can change without a plan. So do it different. Take control before inflation and tuition quietly steal your future. Go visit our website at www.mergentadvisors.net. That is MERGENT, mergentadvisors.net, or mergentcollegeadvisors.com, specifically around college. Let's build a strategy that protects your income, preserves your lifestyle, and keeps your wealth working for the things that matter most.
Awesome. Well, Doug, I appreciate you coming to the show. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.